Morning everyone, can you hear me at the back? So understanding the budget impact on small businesses. I don't think I can say what the impact is unless we just quickly go through comparing the position before with the position afterwards. So I'll do a little bit of where we are now, which is still the case generally until start of the new tax year, Wednesday week. And I think we need to look at not just current taxes, the taxes on the profits you earn or the money you spend, but also perhaps a little bit some of the longer term taxes as well, on capital gains and possibly passing wealth on at the end of your career, perhaps passing the business on to the next generation. There's some obviously tax hits there if you don't get it right, and there's some great release if you do. Just a bit about McBride's. The firm that I work for, we employ about 40 staff. Turnover is about £3 million. So we're a small business too. We've been around just over 40 years. As Jason mentioned, we're about 12 miles up the M20 at Sidcup. And so our client base is almost exclusively owner-managed businesses, from the very small ones, one-man bands, through to some quite chunky corporates. But none of them are listed companies. They are basically owner-managed businesses. So your sort of business. And that's what I've specialised in advising pretty much all my career. Had a couple of occasions when I've been to bigger firms, but I've always come back to owner-managed businesses because I think I identify much more with that type of client and dealing with the people that make the decisions. And that's when tax can be most effective, is when we're actually in with helping you make your decisions, because there's a right way and a wrong way to do it, usually from tax, or a better way and a worse way. So, you know, if we're in the know on what you're doing and how you want to structure things, what transaction you're going to undertake, that's when we can make the biggest impact. But let's go back to the budget. Really, tax from a business perspective really depends upon what structure you've got. And I've noted 4 on there, the 4 main options. You can be a sole trader, you just on your own. You might employ people, but you take all the profit or the loss, you take all responsibility. You could be a partnership, and I've distinguished a normal partnership from a limited liability partnership. Now, all of those 3, the top 3 items on there, from a tax point of view, they're all what I would call transparent. So you, as the partner or as the owner, sole trader, pay tax on the profits. All right? Directly you earn them, or for the year that you earn them, you pay the tax on them. Whereas the distinguishing factor with a company, obviously the company owns the business, it pays taxes, but it doesn't stop there. If you want to take some money out of the company, and most people have to live on, or to do things they want to do with it, you have to pay some more tax to get it out of the company. But the company pays the tax in the first place on the business profits, and you pay tax on what you get out. And the bottom 2, of course, are very common business structures because they have limited liability protection. It's not a tax matter, but it's quite useful to know that if a creditor sues you for whatever reason, rightly or wrongly, the judgment goes against you, you have limited liability, so it doesn't go any further. It stops with the business. Okay, I'm just going to look at the taxation of individuals quickly, and then companies, and then compare the two. What I really want to focus on are the 2 columns headed dividends. So the right-hand one and the middle column headed dividends, because that's where there's a change. That actually it was announced before Christmas, but it comes into effect on the start of the new tax year. Dividends, basically across the board, the rate of tax that you pay on a dividend from a company has gone up by 7.5%. Okay? It used to be 0 for a basic rate taxpayer, so you could take your profits out of the company, and if you're only, as a dividend, if you're only a basic rate taxpayer, there was no tax on it. Going forward, it's going to be 7.5% tax. So that's an increase, and basically the same. If you're a high rate payer, that means you're paying the 40% rate of tax on other income, but on dividends you get as a special rate of tax. So if you like, that's the downside in the budget, and for taxes for people taking profits out of companies. If you do it as a dividend, then you pay more tax after the 5th of April. And many businesses will be taking profits out as a dividend, because there has been lower tax overall, the business and the individual combined, to take it as a dividend rather than remuneration. It was roughly a 10% differential. Now with 7.5% extra tax on dividends, the differential is much smaller. In many cases, it would still be just beneficial to take a dividend rather than remuneration, but that's the overall take on that. The bottom half of that slide shows where personal allowances and the basic rate band. Remember, we get a tax-free allowance. From this April, it goes up to 11,000. From next April, and this was announced in the budget a couple of weeks ago, it goes up to £11,500. So for a 40% taxpayer, it saves you 40% on £500, £200 a year. The basic rate band is going up to 33,500 April next year. So it's been announced a year in advance. Goes up by £1,500. So it saves you the difference between 40 and 20 on that £1,500. So it saves you 20% of 1,500, which is £300 a year. So the combination of those two saves £500 a year in your pocket. Useful to have. With some other changes I'll mention later, it all mounts up. Okay, comparing that was personal tax with company taxation, the other main business vehicle. Corporate tax rate is a flat rate of 20%. It's not special for small businesses anymore. They used to get a much lower rate than bigger businesses, but now all businesses in the country, all companies pay a flat 20% rate. They did for the current year, they will from April 16. From April next year, corporate tax rate goes down to 19%. So it's already the lowest in Europe, apart from the pure tax havens, but of the sophisticated countries, it's already the lowest. It's going down even further. And the change in the budget was that from April 20, and I know that's 4 years away, but you know, it's been pre-announced that the rate will go down to 17%, which is very low. In fact, 10 or 15 years ago, when the UK had some anti-avoidance rules for taking profits into offshore companies, when the UK rate was 35%, if you had a 17% rate, you would be deemed to be a tax haven because it was less than the UK's main rate. Now our own rate is less than the rate we used to call a tax haven. So, you know, it's quite low. And perhaps I'm being cynical, but if you have problems with companies like Starbucks and Amazon who are taking profits offshore and not having much of a tax base onshore, if you can reduce the tax rates, they have less of a saving to make, and those that have got their profits onshore are making the saving. So perhaps we're seeing a shift from corporate taxes to other taxes in a partial response to that. But it also makes the UK a good place to come and do business if you're a multinational. Most of us don't have the choice, we're here anyway, but it does attract business into the country. One change that was in the budget, just down the bottom there, relief for losses. Historically, there has been, if you have a loss from trading or from non-trading income and you can't use it in that year, you have to carry it forward to use against your future profits. Well, if it was a trading loss, when you carry it forward, you can only use it against future trading profits, which is useful if you've got trading profits in future. But if you have a couple of bad years, the second year you can't use it. But now, going forward, you're going to be able to use it against other sources of income. So if you have some investment income or some capital gains, you've got to use it against those when you carry it forward. Or even if you've got a group of companies, now, they don't have to be big to have a group of companies, you can have a couple of small companies. If you brought forward loss, you'll be able to surrender sideways against the profits in the other companies in the group, which is something you haven't been able to do before now. The only downside from this at the moment is that it doesn't apply until April next year. So again, it's a little bit more jam tomorrow, but at least it's a favourable movement in making much more flexible how we can use trading losses. And you know, with the best will in the world, businesses do sometimes make trading losses. And sometimes those are pure trading losses. Sometimes they're because you've had tax allowances on expenditure on plant and machinery or enhanced research and development expenditure. So there may not be a real loss, commercial loss, but there might be a tax loss. So this is going to facilitate how you can use them going forward. There is a restriction. If you use a brought forward loss, it's only going to be limited to 50% of the profits over £5 million. So big deal for most of us. Making £5 million, I I wouldn't mind a restriction on the profits I can set my brought forward losses against. But that's meant to say that the banks and other huge companies can't benefit to the same extent as a small business. So favourable to small businesses. Okay, so we've looked at personal tax rates and corporate rates. The question I get asked a lot when advising small businesses is, should I be a company? Should I be partnership, LLP, sole trader? And this is a very basic comparison, but if you look, the first column headed direct, and I'm assuming I'm a 40% taxpayer. I've got enough income to pay the 40% rate, so I've got taxable income of over £33,000 going forward. If I don't have a company, I own the business directly, or I'm a partner. Let's suppose I've got £100. This is about percentages, not real pounds. Percentage. I've got 100% profit. I'm not paying corporation tax, so I'm paying income tax at 40%. So I've paid that. I've got after-tax cash of 60 in my pocket. I've ignored national insurance for a minute, just to keep the comparison simple. So I'll keep 60. If I'm a company, I'm operating my business via a company. Company only pays 20% corporation tax. So I've got 80 left in the company after paying corporation tax. Now that's rather better than the 60 if I owned it personally. All right? But, the big but, is the money is still in the company. If I want to take it out to live on, I've got to pay some more tax. Now I've got to pay some income tax on taking the money out of the company. I'm assuming we're doing it as a dividend here because that's just a bit better at 32.5% than 40% income tax. So I pay 32.5% on the 80, so I've paid 26% tax personally, leaves me at 54. So, golden rule there is to the extent you can afford to leave money in the company to grow the business, you only pay 20% tax, you're left with more. But if you have to take it out, you're left with a bit less, because you've only got 54% left. So, there's a comparison between the two. And most of us have to take some, if not all of our profit out, but if, as businesses grow and want to plough it back in, the extent you can plough it back in and you're using it a company vehicle, you're only paying 20% tax on the profits you leave in the business, which is considerable benefit compared with you don't get the choice if you own it directly or through a partnership. You pay tax on the whole profit, whether you can draw it out or not, because it's transparent for tax purposes. Just to look at the comparison for a basic rate taxpayer as opposed to a higher rate taxpayer, you only pay 20% income tax if you own it directly, so you're left with 80, which is the same as the company position. So there's no real benefit for having a company. And if you have to take money out of the company, you're only left with 74 in tax. So it's, again, a company is worse if you take the money out. It's neutral if you leave it in, if you're a basic rate taxpayer. Just some things to bear in mind. Okay, just want to explain a little bit more about who should own the business or the company. And I don't want to dictate your commercial terms, but this is really meant to say if they're a husband and wives, each person in the country gets a personal allowance, £11,000, has a basic rate tax ban up to £33,000 at 20% tax. So if you yourself run the business or through a company and take dividends out and you're the sole owner, you'll be paying tax probably at the higher rates if your profits are quite reasonable amounts. If your spouse perhaps is at home or perhaps has a lower paid job, they may not be using their personal allowance, or they may not be using all their basic rate band. So if you can transfer income to your spouse, it may come off of your tax rate at 40% and be taxed on them at 0 or at 20%. Okay? Now, I'm not saying you can just do that, transfer the income, but if it's a trading business, if you made them a partner in the business, for example, and they had a profit share, or if it's a company and you give them some of the shares and they can take the dividend on those shares, it's a real gift. We can't just do this just for tax purposes, but it's a real gift of the assets to them. They become entitled to that income and they could save tax between you, as it were. So, if, for example, your spouse doesn't have any income at all and they have a personal allowance of £11,000 they don't use, if we move the tax from from you at one of those rates to them at 20% tax rate can save, or sorry, at 0% tax rate because it's tax free, they could save £5,000 a year in tax if it's trading profits, or £4,000 if it's a dividend, because they're slightly different tax rates. And if they have an unused basic rate band of £32,000 and it shifts from your tax rate to their tax rate, you can save either 8 or 10. So just by moving profits from one spouse to the next, you can save, say, £13,000, £14,000 a year maximum. It might be less. It's still worth having a look at. This is not reprehensible. It's just sensibly structuring your business, okay, and who owns it. So there's things you can do, relatively simple things, to minimise tax. All right, moving away from income tax directly to other taxes now. National insurance contributions. Well, I guess the good news is there was no change in rates. I say it's good news. It could have gone down, I suppose, but it doesn't happen, does it? Rates go up generally on national insurance. Not the same as tax, but it is a tax by any other name. So no change in rates is good news. Very good news is the employment allowance, which is every business in the country gets this, whether they be a mega company like ICI or whatever, or whether they be a one-man band company, or indeed not company. Your first £2,000 of national insurance contributions you don't have to pay, going up to the first £3,000. So that's £1,000 extra in your pocket from 6th of April this year. Very important, goes straight through to your pocket. As I say, the big companies get the same allowance, but it doesn't mean much to them, does it? 1,000, whereas £1,000 extra to a small business means a lot. So I think that's very favourable for small businesses. It was announced that from a couple of years' time, don't really know why it couldn't be done sooner, but it's 2 years' time and these things take a while for the bureaucracy to process the systems. But Class 2 national insurance contributions that self-employed pay, not a big amount, it's about £3 a week, but it's another £150 a year saving per partner or per earner. But also it's another level of bureaucracy that's gone. You haven't got to worry about paying those. So that's just being abolished in 2 years' time. Whether Class 4 national insurance for self-employed goes up to compensate for it, don't know. That wasn't announced, but you have to be slightly wary about giving up what they give away with one hand and take back with another, perhaps. But let's hope so far that's all we've heard. The bottom point there, salary, it was actually announced in the small print of all the press releases on budget day. But what you probably don't know is that although the Chancellor stands up and he speaks for an hour or so and spouts some headline stuff, and some of it goes over your head and others are figures, and some of it, I recognise that, etc., etc. Basic rate of income tax and personal allowance, he takes credit for all of those things. Is that there are a couple of hundred pages of press releases that come out that have all the detail on the tax changes. Now, we got all of those this year, but some of the changes there was very little detail on. But the last one there was quite helpful. It had been rumoured that the national insurance savings from salary sacrifice for certain benefits, particularly pension contributions, will be removed. But it's actually confirmed that they're not. They're still going to be available. What I mean by that is, let's supposing you want to pay a pension contribution. Now, if you get your salary, you pay tax and national insurance on it, and your employer pays national insurance at 13.8%. So there's quite a lot of tax gone out the window there, or national insurance in particular. You pay a pension contribution, you can get the tax back, you can't get the national insurance back. Because pension contributions are a tax deduction, not a national insurance contribution. So, if you can arrange it, and if you've got your own business, it's easier to arrange for you and possibly for your staff for their pension contributions to be paid by the employer, not by the employee. So you pay it direct to their pension scheme. That way, there's no employers or employees' national insurance contributions on the bit that goes into the pension scheme. So it can save the employer 13.8%, the employee, well, possibly 12%, but if they're already into high rates of tax, only saves them 2%. But it's a very worthwhile saving, and a lot of businesses do this. It's just changing the way you pay the pension contributions. And it's not the revenue don't attack it. In fact, it's just been announced we're not going to change the rules on. We know people do it. We're going to allow it to go on. It's just a sensible way of structuring how you pay this very important benefit for your staff, or indeed for yourself. It also works for childcare vouchers and some obscure benefits too. But if you, instead of paying your staff cash, you pay them in childcare vouchers through the scheme that there is. That can be national insurance free as well. So that could be quite a useful way to perhaps give your business or indeed your staff an increase in take-home pay by pension contributions and possibly childcare vouchers being via salary sacrifice. Okay, moving on from NI to business rates, and Chancellor made a big play of this, and I think it is very important. Small business rate relief, I think up to 6,000 currently, starting next year, I think, unfortunately, not straight away, it will be £12,000 of rateable value before you pay any rates at all. So that takes a lot more small businesses out of the net for business rates. And there's a tapering up to 15,000 of rateable value. So that will take some more businesses out. There's also, for slightly bigger businesses with a bit more rates, up to £51,000, you get a slight reduction in rates, not an abolition of it, but or exemption. So that's quite a high figure, and that comes in next year. You'll pay less rates than the standard rate. So quite a lot of businesses will benefit from that. Capital gains tax, and now I'm moving in away from the immediate taxes, perhaps to the medium, longer term taxes, because I think we all hope that at some stage we might be able to sell our business on. Maybe when you're coming out to retirement, maybe much sooner. Some people do it in a series of disposals. Serial entrepreneurs. We'll see. But the good news is that capital gains tax generally is being reduced from April this year, so only another 8 days, from standard rate of 28% to a standard rate of 20%. That's quite a respectable rate, isn't it? 20%. It's half the main income tax rate of 40%, so only 20% capital gains tax. If you happen to be a basic rate taxpayer, it's going down from 18 to 10%. But if you make a substantial gain, it's going to push you into the higher rates of tax anyway, so you won't get very much at that low rate. But the 20% rate is the one you need to focus on. One important restriction is that it doesn't apply to disposals of residential property. There's been a few changes recently that have been prejudicial to buy-to-let property owners as opposed to a mainstream business. The government's trying to encourage people to buy their own home, and they think that more people that own buy-to-lets, it takes housing stock out of the market. We'll see. But then this reduced rate of capital gains tax doesn't apply to disposals of residential property, only to other assets. We can all make 11,100, I think, for next year, capital gains tax free, so small gains on stocks and shares, probably not on your business, unless you want to give it away perhaps to your kids on dribs and drabs. You could give away £11,000 of shares, for example, away each year for a number of years. That would work without paying any capital gains tax or inheritance tax. The most important thing on there probably, though, from a business perspective, is the very last bullet point, which is entrepreneurs relief, which has been around since 2008. And basically, if you make a capital gain on disposing of shares in your private company, and you are a director or employee of the company and you own at least 5% of the shares, then you can get a 10% capital gains tax rate, as opposed to what's now 20. So it's half the main rate until the next tax year, when the main rate is 28. It's about a third of the current rate, so it'll only be half going forward. But it's still a great rate of tax. You can build up your business, make it a very substantial business, sell it on, and pay 10% tax on the profit from selling it. Doesn't just apply to shares in trading companies. It also applies if you're an owner in a sole tradership or a partnership, and you sell it's a trading business, you sell it on, you can get the 10% tax rate. Of course, there are rules surrounding that. You have to make sure you don't get on the wrong side of them, so it's normally worth taking advice, and not the last minute, at least a year out, because most of the conditions you have to satisfy for the last year of ownership. So make sure you're on the right side of the line, because there are some niggly little rules that might catch you if you're not careful. But 10% rate for entrepreneurs disposing of their business is fantastic in my view. Even longer term perhaps is inheritance tax, and we can all make a gift or a disposal of up to £325,000 that is called a nil rate band. It's like an exemption, but technically it's a nil rate band without paying any inheritance tax. If, as in most cases, husband and wife leave assets to each other, then first spouse to die leaves it to the next spouse. That's an exempt transfer. When the second spouse dies, they can use two people's nil rate band, so £650,000 of exemption, which is helpful, because if you've got chargeable assets, I'm afraid the rate of tax on death is I think a bit swinging at 40%. On you paid income tax when you earn these assets. If you keep them and you die, you're paying 40% death duty on it, quite high as a flat rate. Fortunately, there is something here called business property relief. Very, very important for owner-managed businesses. Basically, this relief says that if you die owning shares in a trading company, that's not a listed company, it's a trading company, then essentially that can be free of inheritance tax. There are some restrictions if you've got investment property in there and things like that, but basically free of inheritance tax. And that's been around for quite a number of years. Don't see that relief going out the window anytime soon. And it's not even limited to 5 million or 10 million pounds, it's unlimited. And I think all governments, of whatever persuasion they are, recognise that if a business owner dies and leaves the business to their next generation or their spouse, the last thing they really want is to pay 40% inheritance tax on that, because the only source of the money probably is to sell the business or break it up, and the governments don't want to encourage that, so they allow businesses to pass to the next generation, or even skip a generation, or even go to brothers and sisters. If you've got business property relief, there's no inheritance tax at all. There are conditions, as I said, like entrepreneurs relief, so again it's worth checking that you satisfy those conditions, and they have to be satisfied for the 2 years before death or before the transfer. So it's worth taking the advice at least a couple of years before. Well, you don't know when you're going to die, so perhaps revisiting it every now and again just to be on the safe side. Now we're coming on to some proposed changes that were in the budget. Some of these start quite soon, some perhaps next year. We'll come on to those in a minute. Now I mentioned earlier that the rate of tax on dividends is going up by 7.5% across the board. Well, and at the moment, until 5th of April 16, if you're a basic rate taxpayer, you don't pay any further tax on a dividend when you get it. It's deemed to be basic rate tax paid. But from April, it's going up to 7.5%. So there'll be millions of people around the country, I think, that have very small dividends, perhaps from the sale of Standard Life and you got some free shares, or perhaps some nationalisation issues, or inherit some from somebody, or perhaps Santander or something like that, where you got some when they floated, acquired Abbey National. And the last thing the government wants, I think, or the revenue, is to have to deal with loads of small businesses or small taxpayers who have got a few dividends and they have to go through and check out make sure you're paying your tax on it. So they introduced a £5,000 allowance, I think, to take all of those out of the equation. So the people this is going to hit most, there are two sorts. It's one who's got a fairly chunky investment portfolio with quite large dividends on it, because the first 5,000 dividends are going to be exempt. If you've got more than that, you pay tax on the rest. And who's the other sort of person that has fairly chunky dividends, perhaps? You guys, owner-managed businesses, because if you're a company, mostly you will probably be distributing a good slug of the profit as a dividend. So really, in a sense, this is the only piece of bad news for businesses. owner-managed businesses, is that the dividend tax has gone up, but the first £5,000 of dividend is exempt. So perhaps, between a husband and wife, you could get £10,000 out with it, no tax at all, and then it starts 7.5% on the rest, etc. So you just have to be aware of that. For the same reason, I think they've introduced an interest allowance, which if you're a basic rate taxpayer, you can earn £1,000 a year of interest and pay no tax on it. It doesn't even have to go on your tax return. A bit like an ISA now, it's tax-free. But it doesn't have to be in an ISA, it's just interest that you earn. If you're a higher rate taxpayer, so your income's between about 32,000 and 150,000 of taxable income, you get a £500,000 allowance. If you happen to be an additional rate taxpayer, you don't get any of this interest allowance, because I think those sorts of taxpayers have to put in a tax return anyway, and therefore we won't give them allowance, so they haven't got to put a tax return in. The whole purpose of these two allowances is to stop lots of basic rate taxpayers or people who pay nearly all their tax through PAYE from having to put in a tax return for the sake of a little bit of a dividend, a little bit of interest. But it applies to everybody, not just those people. An important extension to this fabulous entrepreneur's relief, the 10% rate for the owner of the business when he sells, is there are some times when you might have an investor in your business who doesn't work in that business. He's going to put some money in to buy some of the equity, but he's a sleeping partner, perhaps you might call him, or a business angel, because we do need those sort of investments from time to time. If they can fit into the rules of something called enterprise investment scheme, they can actually get a 30% tax deduction for the money they put in the company and a totally tax-free capital gain when they sell. But you have to, there's very complicated rules around that. It can work for small businesses very well, but you don't always fit the bill. This new extension to entrepreneurs relief says they can have a 10% tax rate when they sell, provided they satisfy their conditions. And the main one is that they subscribe for new shares in the business. So they really have to put the money into the business, not buying some shares from the existing owners. That's the whole purpose, is to get money into businesses to expand them, not for the owners to cash in. So you have to subscribe for new ordinary shares, has to be an unlisted trading company. You have to own the shares for at least 3 years, and then you can sell those shares and have a 10% tax rate rather than a normal 20% tax rate. You can only do that for £10 million worth of gain. Thank you. So there is a cap on it, so that your Richard Bransons and the like perhaps won't be able to benefit to the same extent, but I guess they'll get by. So that's a very fabulous relief for people helping you finance your business by subscribing for new ordinary shares, who might not be directors of the company, just a back seat. Okay, there are also some technical changes which make it better for small businesses if you have interest in other businesses. So I won't go into those, it's a bit too detailed. Something you might come across is what's called loans to participators. Sounds a bit pompous, doesn't it? But if you are a company, one of the things that in the past someone might have said or tried on was, well, if I take money out as a dividend or as remuneration, we pay income tax on that, and perhaps the employer's national insurance. Don't fancy that. Why don't we just have a loan out of the company then? And we'll just take it loan every year. Oh, a loan gets bigger and bigger, but unless there's any tax on loans, why wouldn't you? Well, there is a tax on loans. If a private company, called a closed company, that's controlled by 5 or fewer people, makes a loan to a participator, is another word for shareholder, to a shareholder, if it's not repaid by 9 months after the company's year end, the company has to make a loan to Inland Revenue. Well, you've had your loan out of the company tax-free. They said, well, if you'd have paid it as a dividend, we would have had in the past 25% tax, so we want a loan of 25% until you repay it. That's fair, isn't it? Because the rate of tax on dividends is going up for a higher rate payer from 25% to 32.5%, the rate of tax on loans to shareholders is going up as well. Now you do get that money back when the shareholder repays their money to the company. The revenue will repay their loan back to the company, but the rate is now a third, pretty much, isn't it? 32.5%. So it's a disincentive. You have short-term loans, but it must be repaid by 9 months after the year end. Okay, stamp duty land tax on non-residential property. Essentially, if your property price is more than £500,000, it's a flat rate 4%. You may know that last year the rate of tax on residential property, or the whole way it was calculated, was changed. Rather than if it's over this limit you pay 4% on the whole lot, it's now 0 to 125,000, 0%, the next bit 1%, no 2%, the next bit blah, blah. Well, they're going to change the non-residential property structure of the tax to the same. So it's going to be 0% the first 150,000, 2% the next 100,000, and over £250,000 it'll be 5%. At the moment, it only hits 4% maximum ever. So, what's the long shot of all that? Well, if you buy a property for up to £1 million, a commercial property, you will actually, on those scales, pay less tax than you do at the moment. If you buy a property worth over £1 million, you will pay basically 1% extra on the bit over £1 million. So, property up to £1 million, better off. Over £1 million, worse off. That's the way it is. This is more personal tax, but fairly generous increase in the amount you can put into an ISA. No tax deduction on the way in, but everything that grows in there, income, dividends, interest, capital gains in there, if it's a stocks and shares ISA, all tax-free. Take it out, tax-free whenever you like. I think we're trying to get here, especially with this what's now called a lifetime ISA, trying to be an alternative way of providing for a pension. So if you happen to be an adult under the age of 40, you can actually put into this 4% per annum, sorry, £4,000 per annum maximum. You don't have to put that much in, that's the maximum. And the government will contribute 25% of whatever you put in. So if you put in 4,000, they'll put in 1,000 per year. Quite generous. I take the view this is a bit like pension contributions, because if you put in a basic rate taxpayer to put a pension contribution in of £4,000, that's after basic rate tax of 20%. So the government tops it up to 5 in your pension scheme. Well, they're doing it here in an ISA. The only difference with pension schemes is if you're a higher rate taxpayer, you get some more tax relief on top of that. But here it's just going to be the basic rate is going to be repaid into your pension scheme, into your lifetime ISA. Still fabulous because it doesn't exist at the moment. You're getting a quarter of whatever you save, the government will top it up. And you can only draw it out in 2 situations. From age 60 you can draw anything you like out of it. Before then you have to use it to buy your first home. So it's targeted at improving people's ability to buy their first home or provide for a pension. I think that's quite clever. It's something that doesn't exist at the moment, so definitely a step in the right direction. But it's not until April next year. Now you might say, who the hell are the Office of Tax Simplification? Well, it does exist, yeah. It was brought in probably 4 or 5 years ago. And I think George Osborne, I think it was, said, well, look, tax is complicated, and a lot of small businesses in particular spend a lot of their time, as unpaid tax collectors. I think we all identify with that. It would be good if we can simplify, but we have to do it in a structured way. We can't just sort of abolish all sorts of things, although they do abolish some things like Class 2 NI. We need somebody in charge of that, and they have to have some staff to look at what things we could improve and simplify. So they've done a number of things over the years, but what they've actually just published a consultative document, I'm afraid. It's not action today, but it's how we might do it, on the simplification of small company taxation, making it perhaps see-through, making your taxable profits the same as your accounting profits, those sorts of areas, aligning tax payment dates for the various taxes. So that might come in future. They've suggested, and this is novel, I've never had this before, as I said earlier, you can have a limited liability company, you can have a limited liability partnership. You can't have a limited liability sole trader if you're a one-man owner of the business. They've proposed there is some sort of entity that's limited liability protection for a one-owner business. So that should hopefully come in future. And the big winner for many people is the last item on there, aligning income tax and NIC. That's been sort of a bit elusive over the years. It's been suggested, but I think the problem is there'll be winners and losers, and so the losers won't be very happy. The winners might be ecstatic. So they've got to be careful about how they bring it in. It's a big change if it ever happens, but it ought to, because NIC in many respects is just another type of tax, isn't it? So if we didn't have the separate calculations for it and different weekly and monthly rates, just all went through the income tax, that must be a big simplification if we can get there. I'm nearly done. So what hasn't changed? Sometimes that's quite important. Well, there's no national insurance on dividends. Now you might say, well, was there ever going to be? Well, it has been suggested that owner-managers have a big advantage over if they carry on business through a company, because they can take their profits out as dividends and there's no national insurance on those. And that's definitely true. It is a big advantage, which is why taking out your profits as dividends is better than remuneration. However, the new increase in dividend tax of 7.5% is going to erode most of that differential. So that's the only piece of sort of bad news, the dividend tax really. We've still got income splitting opportunities, as I mentioned, using your spouse's basic rate band and perhaps their unused personal allowance is still around. Business property relief, with this 100% exemption from inheritance tax, is still there and it's still not limited at all. Entrepreneurs relief for capital gains tax is still around the 10% rate rather than the normal 28 or going forward 20%, so that's still there. And you can earn up to £10 million of gains over your life and get that rate. If you're lucky enough to have gains of more than that, I'm afraid you pay the full rate of 20%. EMIs, Enterprise Management Incentive. I haven't mentioned that earlier, but this is a share option scheme for company employees, where perhaps some of your key people want to tie them in or reward them over the years. We can structure that so that they only pay a 10% tax rate when they sell their shares, rather than the usual rates you pay on income tax of up to 45%. We've still got pensions tax relief at our highest marginal rate if you make a contribution. So, up to 45% tax relief on that. Some limits if you're a high earner, so you can only put in 10 grand if you earn more than £210,000. But for the rest of us, you can pay up to £40,000 a year and get full tax relief at your marginal rate. And there are very generous limits for things, EIS, Enterprise Investment Scheme, venture capital trusts. When you get a business angel to invest in your business, they can have very generous tax reliefs for investing and when they get a capital gain, which encourages them to invest, get cheaper money that way. So just to sum up, the overall impact on small and medium enterprises, or owner-managed businesses, I like to call them, as business rate relief increases. So that's not business rates increases, business rates relief increases. So you pay less business rates for most small businesses. We've got corporation tax rate reductions going forward. We've got a lower capital gains tax rate when you exit the business. We've got the current, coming in next week, increase in the national employment insurance employment allowance from £2,000 to £3,000. And I think it's only directly relevant to us, but it makes you give a nicer, warmer feeling inside, is there was a lot mentioned in the budget and all the press releases about focusing on tax avoidance and also about multinational companies. They're two different topics, although they do overlap quite a lot, I think. As we'd like to think that there should be a level playing field between owner-managed businesses and multinationals who are perhaps structuring their affairs. They take a lot of the profit overseas, so they don't pay tax in the UK on it. There's still a lot of focus on making sure they pay their fair share. That makes me feel better as a tax advisor than these people who can afford, fancy offshore structures that the rest of us can't. So the only unfavourable thing is the dividend tax rate increase. So it seems to me overall a very favourable budget for small businesses. Within the parameters the government has got there. They can't give away loads of money. It doesn't happen that way, does it, in real life? But they've done as much as they possibly can.
Thanks very much, Dave.